We are on recording, and right now we got the start of the night.
Oh, he's
right
here?
He's here
Okay.
with his
All right,
camera
perfect.
on, which is great. Not like some other people that they are hiding behind no picture, no nothing.
Yeah.
So we are 14 minutes into our discussion. So hopefully everything that we were talking before, it was always meaningful. Make you think about how we can keep growing as individual investors or as a group. But you know that always the end game is that you need to work with other people. That's unfortunately the way that life is. That's why you need two people to create another human being. So, and I'm not going to expand or go deep in that concept, but I thought that was the easiest way to get to the point that in business or in life, you always need, other people. The journey is trying to find the right people for that journey, for that tranche of your journey, for that season of your life, or forever. Um, that's the main concept that we I think we are trying to instill in the meetup, in the squadron. That's why we said we should have here not only Michael, we should have a title person, we should have a legal person, and all that kind of thing. And that's also the purpose of building that site that we built this year. And we have to have different people that they are different members of the entire community and the entire team. I know Michael for a long while. He came to the squadron 3-4 years ago. 2020, 2021, came with his wife, kids, then he came alone. He said that he lives up north, so that's even more kudos for him because more I don't know, really feeling that he finds value in the meetup, coming and going and doing all that drive. He has been always doing the same thing. So for right or wrong, he's sticking to his game. And now we are supporting Mike to do more work with us, with anybody of us, with the people at the squadron. And I will let now, the other thing that I would say is the typical thing that I said every Thursday. We would like to know if you want to get the 1% a month for 3 months or 3% in 90 days. So we can have that EMD money, that at risk money ready when we find a good opportunity to jump in. Now I'm going to let Luis talk about it, and then we start the conversation.
Yeah, more like not talking. Not today. Today we wanna. Michael is the one that's going to help us to speak. Tell us something about you, Michael, and also tell us something about you. Who are you, Michael?
How you guys doing tonight?
Good.
Awesome. Yeah, so I guess we're going to talk a little bit about DSCR loans and how the interest rates are affecting them right now. Obviously, when my camera went out. When the interest rate is lower, it's more favorable for us as far as DSCR is concerned. The more equity, the more liquid a property is, the more cash flow, the better it is for the bank and the better it is for the investor. So this is working in our favor right now as far as the interest rates dropping.
You were a bit too advanced. Let me guide you. Okay, these guys, we first need to understand. Start like why people use a DSCR loan. Let's go. Why people use a DSCR loan or a bridge loan?
Okay, a DCR loan is a debt service cover ratio. It's minimal paperwork. A lot of it depends on the cash flow of the property. So a lot of times we won't require bank statements or tax returns. We do look for seasoned investors, though. The more projects you have under your belt, the better interest rate you're going to get. DSCR loans typically are fully fully amortized 30-year, 40-year, or even interest only for a specific amount of time. A lot of times people will
Hold on, you speak louder usually. Other than Ryan, we have him for us. Ask him questions. Don't let him tell you things that you don't understand what he's saying. We're in a very good position right now. We have
Okay.
a lender, somebody has experience that did so many of these DSCRs. Usually in your life, when you are an investor, you do 2-3 a year if you're very lucky, if you're very active. Maybe you do one every 2 years.
So
What?
I guess like the first thing that comes to mind is, so we can ask questions right now. Is that what you're saying?
absolutely.
Yeah,
Yes.
yeah. So
Good
I was
questions,
wondering.
though. No, only good questions.
Okay, well, I might have a bad question. You tell me if it's a bad question, Michael. You tell me. So, um, you were talking about how when you go through DSCR loans, you look for seasoned investors. So I'm looking at myself as an example, as an investor with this group. I haven't bought a multifamily property on my own yet. So like, am I somebody that's what you're not looking for? Is that like what you're saying or not really?
No, absolutely not. We work with people that are first-time buyers into the DSCR program,
Okay.
but you benefit from working with a team. So
Okay.
maybe you're not the principal, maybe someone, the GC or someone that you're working with has more experience.
Right.
Um, and all DSCR loans are going to close in an LLC, so it's not going to be just you by yourself typically. But yeah, no,
Okay.
it's just, right now, and on the hard money aspect of it, you're looking at 13, 15% on a first project, whereas if you had 3 or 5 under your belt, you may be looking at 10.9, in that range. And then also from
That's under the experience.
yeah, that's under the experience. And then
Okay.
from a bank aspect, banks also do DSCR, which I also have relationships with. We can, you're looking around 2.75 prime plus 2.75, and banks are a lot quicker to respond in the interest rates when they're lowered versus hard money. It takes a little bit of time for hard money lenders to come down when things happen, so fast with the rate change. So you may be able to get a better rate, but the experience is going to go a longer way with banks versus hard money.
Yeah. Okay.
I don't know why my camera
We lost your
Yeah, I
camera.
was gonna say,
MG, if
I was
you're
gonna
doing
say
something.
we can't see you. We can't see you, man. We can hear you, but we can't see you.
There we go.
Much better. No, guys, but let me ask you, Michael, is there any, when you buy properties as an investor, is there anything else that will compete with a DSCR loan? DSCR loan, like
It depends on the situation. Obviously, bridge loans can be very beneficial. If you already have an exit strategy or a larger loan that you're waiting to close on, say an SBA loan or a conventional loan.
right, but but we wouldn't say that it's like 90% of the people should go get the DSCR loan.
Yeah, yeah,
And
absolutely.
it's obvious because it has a characteristic that you guys have not been go through or been go through. Okay, it's not based on your income. It's not based on your credit.
Correct.
No, it's based on the property. That is so important for many reasons, guys. Because if you were buying, he can tell you a conventional loan on a duplex, triplex, he still can do a conventional loan, but that is against your credit, against your income. And that will hurt your credit because now you have more liability on your credit.
Yeah,
The
yeah.
DSCR loan
DSCR.
doesn't show in your credit. It's like corporate.
Absolutely. DCR loans are very beneficial for people who don't have a lot of liquid, who don't have a lot of experience. Like I said, experience does help with the interest rates, but they're very, very beneficial for people that are getting their skin into the game, just starting out, don't have a lot of experience, don't have a lot of money, and want to get into the multifamily or investment property sector. DSCR is, in my opinion, is the way to go. That's what I would do if I was just starting out all over again.
Yeah.
I mean, that's why, guys, the moment you go to refi, because you have to refi your bridge loan. Because why, Ryan? What interest a bridge loan has, Ryan?
You tell me. It's probably high.
You need to know. Samar, what interest is in the market today for hard money loans? You're mute.
You're on mute. You're on mute.
Yeah, for hard money, I don't know, just 10%.
At least 10%. And like Brian said, like Michael says, DCR loans
Michael.
are prime +2 are going to be lower 7%, 7.5. You say something very high there, 9. I want 7.5. I was quote 705 the last month, but like guys, you 3 point, I mean, you can decrease from an 11 hard money going to a 7 something is 3 points less. In $1 million, that is $30,000 less a year. That's $2,500 per month. That can change already your cash flow from that building.
I was gonna say it makes a huge difference. The
It makes a
percentage.
huge difference because that's why we say it's not only that you need to make money, you need to understand the best way to pay your loan, because that also, I mean, how you make money, either making more income that you cannot increase more the rents, you already have the top of the rents, so now lower your cost on the building. One thing to lower my cost is DSCR. Yes, I mean, going from hard money to DSCR is a no-brainer. You have to do it. It's going to be always at least 2 points less. So you
Would
have
you say? I was wondering. I guess I'm asking all the questions right now, but like when you're first getting involved in this, like dealing with a group and partnering with you guys, it helps you a whole lot more to get a DSCR loan compared to like if I were to do it on my own, obviously, or is that not is that not a correct statement?
No, that is a correct statement. Yeah, absolutely. DSCR will go a long way in helping you. I think the most important thing for you as an investor is to do your homework on the property first before you take it to the bank. Have all of your numbers correct. You know, typically a bank will fund a DSCR loan in the 1.2 range. There are some products out there that'll go at 1, even below 1, depending on future cash flow. But for you, you don't want to be stuck in a situation where the property is just cash flowing to cover your expenses, and let's say a renter leaves or something happens, now you're in the red. So the most important thing is to look for, in my opinion, is to look for a property that is 1.3 or higher.
right.
Yeah.
That's very important. Now he's telling you something that you guys usually don't know or don't look at it. The bank is helping you because they're going to analyze the numbers very well. And if the property doesn't cash flow, it will tell you, guys, you cannot buy this. Why are you buying this?
Yeah.
So,
You got an option always.
So like, would you say like 1.25? I think you said at the squadron one time, Michael, that like 1.25 is a guideline, like something there and higher, correct? Is that
Yeah,
what you said?
1.25 is a guideline. You can get a property under a DSCR loan at 1.25, but for me, I'm more comfortable with 1.3 as an investor.
Okay. Yeah.
Yeah,
Fair
as an
enough.
investor, as the bank will fund it, but as an investor, I would expect you to have cash in reserves and a strategy if something were to happen when you're at that 1.2, 1.25 range.
Mhm. Yeah. Fair enough.
Now I have a question for you. No, Michael cannot answer first. The other people have to answer first. We should have a contest. What do you want? Do you want a regular amortized loan as a DSCR, or do you want an interest-only DSCR loan? That's a question.
It all depends.
Another,
It all
no.
depends. It's always.
No,
It
but
all
you cannot answer
depends.
to either. No, JB, you cannot
You
answer.
Javi, you can't answer either.
You can answer. You know, is Samar,
Can you ask the
Anaran,
question?
and Ryan.
Can you ask the question again?
Oh my God, that's why we're gonna have a lady in the room. Okay, okay,
She's paying attention. That's what it is.
we don't repeat things in this room. Okay, you're gonna, Michael is giving you a DSCR loan.
Yeah.
You have the choice, interest only or amortized loan, the ones that have principal and interest. Which one do you want?
Interest or
Anna, then you can also help.
Yeah, so I guess it depends how much money you need and for what purpose. If you need, if it's like a pretty good property that you're gonna just kind of fix and flip, you'd probably take the interest only, because I think it would be a cheaper interest rate. And if it's, you're shaking your head, but anyway, so that
I was gonna
or
say, wouldn't the interest
It's
wouldn't the
not
interest be
cheaper.
higher?
We'll ask Michael, but it's not cheaper.
okay, but I'm
You're
then I'm
okay.
thinking if it's buy and hold, then you may want to spread it out. And also, like if you need money for renovations, you could possibly pull that in.
Okay, let me refresh the question, and you were totally correct saying it depends. Okay, again, interest only, it means less payment. Interest plus principal means more payment. So like you were saying, it depends. Yeah, it depends. Let's say I want to cash flow more, I take an interest only.
But I said it was cheaper, and you said no.
But
It's
I'm not the expert. Michael is the expert. I know it's not. The
an
bank is
interest
taking
only
more
loan
risk.
is not cheaper. It's usually typically 1.5 to 2.5% higher in
No,
interest.
no. 75
Oh,
they charge me, Michael. Michael, I need to fight your rates. Your rates are too high. They charge me like 0.50, sometimes more.
Oh, really?
Yeah. We need
Yeah,
to
no,
check the bank.
it can go as high as 2% higher. Oh, I mean higher than a 30-year or 40-year fixed DSCR loan.
Yeah,
It can
it
be
goes a
it
bit
can be
higher on the interest is higher. I mean, see, the bank is not getting more money. The bank wants you to amortize the loan. The more money you pay into the loan, the less you owe. The bank is more comfortable because my collateral is bigger and your loan goes down. So you're going to always pay me. The more years you're into a loan, you never stop paying. So
Yeah.
they don't like interest only because now you are in control.
Yeah, the longer the term, the lower the interest rate is going to be. But obviously, over the amount of years that you pay, if you take that long to pay, you're going to pay a lot more money. But yeah, the interest rate is typically lower in a 30-year versus a 40-year versus an interest only.
Okay. Let me
Well, I have
And
a
with
comment
the
on that amortization also. For commercial is different than residential. So we need to consider the different amortization.
Yeah.
Like many times we take 10 years or 5 years IO, and then we amortize that thing in a different way. And I will let Michael or Luis explain that. But that's something that in residential, I believe, does not exist.
everything
Yeah,
is
in residential, obviously you have conventional FHA, VA loans, and the interest rates are going to be much more competitive in the residential side versus commercial. The lowest interest rates you typically will see in a real estate deal for commercial is through an SBA loan, which you could compare to an FHA, but the interest rates are still prime plus 275. But yeah, residential loans are always going to be lower interest rates than commercial and investment property.
But what I'm talking about is the difference in amortization. There are more combinations in commercial than in residential. Residential, it seems like it's more straightforward. In the other ones, you have head scratchers like, amortization is the same. Nope, you need to see the term of the loan.
yes, of course, more creative. But guys, you deviate the question is still, or at least what I wanted you to get. I talked to my friend Gran Cardone and I listened to him in YouTube because it wasn't talking to him, okay? And he explained all his loans I do interest only. First, because you want to have as much cash possible on your hand. That's okay. I mean, it depends. I agree with that. But the key, look, if Michael gives you a 30-year loan and the payment is fixed, it doesn't matter if you have extra money, 10,000, 50,000. If you put money towards that loan, it will not affect your monthly payment. But now, if I have extra money and I pay my interest-only loan, my payment changes every month. It's going to go lower and lower. So I will get more cash flow from that by putting money towards the principal. But if I'm the guy first, I control my money. And my wife, but I control my money. And then if I'm going to use it only to invest. One day it could be, okay, I want to invest on this property. Why? Because I need to make $5,000 a month from this property. Then you can think all you have to do is put enough principal to cash flow that amount. And it feels good that every time you put money, your payment is lower. It's based on interest. How much interest you owe? Divided 12. So you're going to decrease your monthly payments by investing in your own property. The other one, you don't even feel it that you're decreasing the loan. So you cannot invest to get more cash flow. That's why I like interest only, but only they charge me 50 points more. And because then I pay what I want, when I want, and I can make my cash flow work for me.
I was just gonna say, like, it's not 100% easy to say that you want interest only. I guess it depends on the situation. Well, correct?
Yeah, it depends on the situation.
Are you taking a floating or are you taking a fixed rate?
Fixed rate.
Okay.
And usually, I mean, guys, I don't know why these banks want to give a 30-year loan. Now it has a 30-year loan. You're going to refinance that in 10 years.
Or less.
I never in my life, I believe I saw only one guy that paid at 29, it was at year 29, paying his mortgage. Have you ever seen somebody paying a mortgage? So don't let this bank lie to you and say, okay, that 30-year loan you're going to, more as an investor, in 10 years, you double your money, you have so much equity, you're going to refinance to buy more investments. Or along this time, like right now, I had DSCRs from last year, they're very expensive. They're 8.5. So as soon as Michael gave me 6.5, I refinance.
Between all of us, one of the reasons that banks use a 30-year or 40-year loan term for the typical home buyer or investor is because it's like a guarantee on a box. It gives you peace of mind that I have this fixed rate for so long, but the reality is, yeah, everyone refinances within 5 to 10 years of the loan. And going back to how one of the reasons that, just to touch on the amortization between commercial and residential, commercial loans a typical commercial loan is 20 to 25 years on the long term, but the amortization goes longer than the actual loan will typically. So the amortization will be over a 30-year period, where the life of the loan is at 20 or 25. So you see a difference in the payments amount versus a residential. The amortization and the loan coincide with each other.
Michael, you spoke in bank language. Let me put it in our language.
I was gonna say expand on the amortization.
What you said was, guys, what he said is the bank is going to give you a 30-year amortization payment, because we only care about the payment, Michael. So that's why
Right.
the bank gives you a 30 years amortization payment. So it's very low, so it covers the DSCR and everybody's happy. But like he was saying, there is a balloon in 10 years, 20 years, or 15 years. The loan is due before the 30 years in some cases. Like Javier was saying, there's so many different variables in commercial that you can work with a bank. But I mean, of course, a bank, I mean, they like the whatever you can get the best rate and you feel comfortable. Today, if you give me a better rate, I will be very comfortable with a 30-year amortization or 40 years amortization if you can, and a 10-year balloon. Because like we say, in 10 years, we're going to refinance or sell. So do you understand, do you guys follow that concept that Michael was telling us? The difference between a amortization payment and balance, no, loan due. When is due the loan?
30 years.
No.
I know, I get it. You mentioned balloon, and I've heard that term before.
Michael,
What-
it's beginning nice to us because that's what we're paying you tonight.
I'm here. I'm here. I'm
Put
just
the
having
camera.
camera
Put the
issues
camera.
for
We don't
some
see
reason.
you.
I don't know. The camera on the laptop keeps going in and
We
out.
need
for
to
some
buy a
reason.
newer camera. Okay. Talk to us. Explain what is a balloon in the loan.
A balloon payment is when the remainder of the loan is due at a certain time, and it'll be all in your contract. It'll be on your HUD or whatever settlement statement they call it now. So let's say your amortization is over a 30-year period, but your loan is for 20 years. At the end of that 20-year period, you'll have a balloon payment for the remainder of the balance. Typically, people will refinance way before this ever happens, but that's what that means. So let's say you have a $400,000 loan, you're making your monthly payments for 19 years and 11 months. On that 20th year, you have a payment due of $32,000. That $32,000 will be due come the last payment of the 20-year period.
Yeah, it involves everything. Everything going forward. That's why it's a balloon. You have a big
But
payment at
that's
the end.
negotiated when you do the loan, right? That's negotiated. That's something you negotiate when you do the loan, right? It's a type of loan, if you will, right?
Yeah, you can. It's almost comparable to like insurance premiums. The higher premium you pay, the lower your insurance payment will be. So you can work it into the contract. Let's say you have a larger balloon at the end, you can lower your payment, your monthly payments for the 5 years or 10 years you decide to keep the loan until you refinance.
But you see, that's something that you need to talk to, like people like Michael that is willing to help you to get the best rate. And I think because if you go to the bank and say, I want a 30-year amortization payment and I want a 30-year loan, now the bank has the risk that you have holding that money for 30 years. But if you tell him, I give you give me a 5-year balloon, that's a bit risky. Now the banks know they need to hold that interest only for 5 years. So they can work out a better rate for you. Because now the bank is the benefit. In 5 years, I only at risk with you for 5 years. In 5 years, you have to pay me back. Your property is going to have a nice value, and you're going to pay me back. Or worse, you're going to have to refinance, so you have to pay me again fees. But that's when we do a loan, we talk to Michael and say, Michael, what can we gain by getting a 10-year balloon or a 15-year balloon?
Mm-hmm.
So the bank likes that thing. They'll give you a competitive interest rate because of it, because they know you're gonna pay it
Faster.
Right? You're gonna pay it faster. Yeah.
They're gonna pay it faster, but the interest rate is more competitive than getting
The
a
interest
30-year?
rate will typically be lower, yeah, on a larger balloon. Yeah, absolutely, and as well as your payment.
Okay. Right.
You were talking about that, Michael. Explain us when you tell me the prepayment penalty 3.5, 5.5, 5.1.
Yeah, there's a couple of different when you apply for a loan, you're gonna have prepayment penalties which diminish over time. So you can have a 5.1, a 3.1, a 5.5, and what that means is over the course of 1 year, 3 years, 5 years, your prepayment penalty will decrease as you make payments on the loan. So let's say you have a 10-year prepayment penalty, and it goes down a certain percent every year, which will be agreed upon before during contract talks. Let's say in year 4 you decide to refinance, you'll have to pay the remainder of the 6 years penalty and then refinance into a new loan. After the 10-year period, if you decide to refinance, there is no more prepay penalty, and you can refinance without any extra charges. Typically, most people go for a 5-year prepayment penalty or a 3-year, depending on what type of property you plan on buying. If it's a fix and flip, or if it's something that you want to buy and hold, you want a longer prepayment penalty, because prepayment penalty also affects the interest rate. So the longer prepayment penalty you choose, the lower the interest rate will be. So if you're at, let's say, 9% on a 3-year prepayment penalty, and you decide to do a 10-year that we're offering at 8.1%, you can save that interest rate payment over the course of those years. But obviously, you're going to have a prepayment penalty later on down the road if you decide to refinance before that time is up.
Guys,
But
did you
you can
get that?
help you
Because that
cash
is
flow.
important. That is very important. And the one I don't like, Michael, is like, I was so surprised sometimes when they gave me yeah, like you say, 3, or usually we go for 5 or 3, but I like how do you call the ladder one? Yeah, 3, 2, 1, meaning each year it decrease. But I don't like a 5, or a 3, 3, because then I cannot refinance during 3 years. If not, you're going to lose 3% on top of just to refinance. You're going to pay a penalty, like you're saying, for 3%. So
Right.
I don't think, unless you really know your plan, I don't like a 5, or a 3, 3. Give me a 5, 4, 2, 1, meaning last year I only had to pay 1% if I want to refinance, but
Right,
not
yeah.
5% for the refinance.
Yeah, and what Lewis is talking about is a diminishing penalty. So over the course of those years, you can have, let's say, a 5-5, so you pay a 5% penalty over the course of those 5 years. So anytime during that 5 years, you would pay 5%, which is probably the best interest rate you'll get. But if you plan on refinancing within that 5 years, you will pay the 5%. The diminishing one that he's talking about, 5, 4, 3, 2, 1, is, let's say, at year 1 it's 5%, year 2 it's 4, year 3 it's 3 and 2, and so on and so on. So by year 5 you're only paying a 1% penalty fee. And at the end of the day, you're talking about maybe a 0.5% in interest rate for the difference in those products.
And this is for DC. This is for DSCR, right?
Yes, this is typical DSCR. You won't see balloon payments in DSCR loans,
Okay.
unless it's some type of creative financing that you're working out with a private lender. But typically, it's just a straightforward amortization and payment schedule. But yeah, the prepayment penalty is going to be there, and it's up to you to decide what type of, if we offer you 2 or 3 different options, it's up to you to decide which one you want to go with and which one best suits your exit strategy for that property.
Exactly.
And is there always a prepayment in a DSCR
Typically, yeah.
or issue? Okay.
Yes, because they're going to guarantee you a better interest rate, because then they guarantee they're going to make money for you at least 3 years. So that's why it works for both ways. If I say, I need you, make me do all this paperwork, let me make money for 3 years. And that's why it works for you, because they lower the interest rate. So I say, oh, I take it. And usually you're not going to go in a strategy with a DCR that I'm going to refinance in 1 year. Property doesn't appreciate that fast. Is I don't know. Usually your strategy is over 3 years, over 2 years at least. So you're not thinking refinancing fast.
Yeah, if you're talking about a year or 18 months to cash out of a property, then a bridge loan is something that you'd want to look at versus a DSCR.
Louis, would you go from a DSCR to a conventional loan? Like, let's say you're going to refinance. Would you refinance to from a DSCR to a conventional?
Yeah,
Is that
you can refinance to any loan product that you want. Once you own the property, you can do it, anything that you want. I mean, if it's more beneficial to you and you qualify for a conventional refinance, then but yeah, and you plan on holding the property, but you will be tied into a 30-year mortgage at that point.
I mean, you're a bit advanced, Samir. I have not even been there, okay? But yes, what happened there is if you have a nice mortgage, a building, $4 million loan, You go to any bank and says, look, I have this note. Do you want to buy it? Do you want me to start paying interest to you? Lower me the interest rate and I give it to you. So yes, you can negotiate with a bank that is in the need of lending money. And if for them, it's demand supply. If they want you make money on you, then you're going to be able to go to from DSCR to conventional to whatever. The matter to you is lower me the interest rate, I change. That it makes sense because there's going to be closing costs involved. But if it makes sense, let's do it.
Michael, I was gonna ask, you had answered Samar's question about going from a DSCR loan to a hard money loan. Like with what you do, like you pretty much help a client like guideline them, like help them along the way. Like let's say I wanted to switch from one loan to another. Like is that your area of expertise as well? Like you'll tell me, hey, straight up, like this loan is better than that loan for this refinance.
I mean, yeah, I have some fiduciary responsibility to my clients, absolutely. But that's not necessarily, I mean, I'm more of finding the right type of loan. And that's why talking and getting it, just like a real estate agent, I need to know what your needs are, what your wants are as far as your property is concerned. So we don't waste time and we get it right the first time. Unless you come to me with, you know, a loan that you're not happy in. And then from that point, you know, we can try to find something that will be more beneficial to you. But no, typically, you know, I'm here to facilitate the loan. If there is any questions or any help that you need, I'm more than happy to help though. Absolutely.
Ryan, to answer that, if I talk to any of my loan guys, lenders, and they don't help me, change it.
Yeah.
They are there to help me because they know more than us. It no matter because they know what's happening at the moment. So yes, and they will help you. They still make the money, so that's the good part for them. It doesn't matter how they get you the best interest, the best loan, and they still get paid. So that's why we do this type of professions that you get paid by doing right, and then you
Right.
get more business because you do right. That's
Yeah,
simple.
there's a lot of people that'll cookie cutter you right into a loan because they've been dealing with this company and they get the best points out of that company or whatever. But yeah, those are the type of people you need to walk away from because
Yeah.
they're gonna put all 10 people in the same loan that they're making 3 points on or whatever it is, and yeah, that's not what you want.
So,
I mean,
MJ, you're no, I was just gonna ask, like, you guys are a direct lender, right? Like, you're not, are you a broker type or you're a direct lender?
we direct lend and we brokerage.
Okay.
Yeah, my company that I own is a brokerage, but we have table lending, and then we do a lot of other stuff outside of real estate as well, like account receivables, invoice factoring, equipment loans, that kind of stuff.
Good. The one loan that I'm going to require, and I already asked Michael to get me. Okay, guys, after you own the buildings for a couple of years, like we have done, I have a lot of equity and I don't want to touch my first loan for any reason. So Michael, what I need now is second lien positions loans on our investment properties.
Okay. It's yeah, those are a little harder to come by, depending on what the property is. Uh there's not as many lenders out there that'll do second position, um as far as investment properties. Your residential home, there's a lot you can do with that, but yeah, it's a little more creative.
Find that the group, we have all the group, a lot of people have buildings and they can use that equity. And some of them, you know, some people in the past, they have very good credit, very good loans. They cannot touch a 4.5 loan. They
Yeah,
need.
and yeah, you wouldn't want to touch your 3.5. Like my house, I have 3.2% on my home. There's no way I could.
That's free money. Inflation is more than that. That's free money for the rest of your life. You never
Yeah.
pay off.
Now there is a product called a HELOC, a home equity line of credit.
I think we didn't touch on prepayments on yield maintenance.
We cannot hear you, Javier. We cannot hear you.
I think we never touched the pre-penalty of yield maintenance for loans, commercial loans. There is another way of doing pre-penalties.
Yeah, but
There's another way to do pre-penalties, and that's the yield to maintenance, yield maintenance.
Yeah.
yeah, but we're talking about the HELOC. You totally lost us.
No, right before he would jump into a new subject. That's what
I
I'm
know.
talking about.
I was just.
And I know that we have 6 minutes, but anyway, it seems like we start
No.
10 minutes late, so we can go maybe 10 more minutes if people are willing to do it.
HELOCs, guys, if anybody has a question on HELOCs, use Mike now. That's the best product exists out there.
Now, Hob, you're talking about the refer to the yield maintenance, right? for
Yeah,
prepayment.
yield maintenance as a prepayment penalty, which
Right.
is a little bit different than the other ones that they are easier to understand. While the yield maintenance, you have the IRR NPV calculation, and you always get a surprise between the servicer and you, and you are coming with an Excel spreadsheet, and they come with another different Excel spreadsheet, and hey, where do we meet?
Right. Yeah, it's a negotiation process. So the lenders can recoup on some of the interest that they lost in the prepayment. When the prepayment penalty is paid early.
What are the qualifications for a HELOC?
Well, first off, you have to have equity in the home. That's number one, or in your investment property.
By investment, I mean, but I mean, depends on the best HELOC, it has to be your primary house.
Yeah.
Because they know you're not going to lose your house. They know you're going to keep on living somewhere. So, of course, you get the best HELOC is on your house, primary home. Some banks, regular banks, will only give you to your primary home. The one I'm asking him to get us, well, if you get me a HELOC on an investment property, that I love you. I mean, a HELOC is a loan out there that you don't pay unless you use it. You use it, again, I always think we're in control of our money. I only use money to invest. So
Right.
you have totally access and you're not paying interest while you have it.
Yeah, a HELOC is usually is credit based. Most lenders look for a credit score of around 700 or higher. I mean, there are programs out there that you can go as low as 650, 630, somewhere around there. And they look typically for 20 to 25% or more of equity in the home at that time.
And the interests are tax deductible because it's your primary homes. So if you borrow your own money from your own house, then you get deductions.
Yeah, absolutely.
And when you make money and you pay your HELOC, you don't have to pay income because you're not making money, you're paying a HELOC.
That's
You
another
give-
way
you-
to
you
use
give
credit
money.
cards to buy something and then do the HELOC. That's even triple way to go and go through credit cards.
Exactly.
Yeah, a bunch of
Exactly.
zero interest credit cards, and then just keep rolling them over to the new zero interest, the new zero interest card. But
You
that's a
cash
whole
out.
nother discussion.
Yeah. So
That's for that one, Michael. That's what we talk on Wednesday. That's when we go to these micro things and making money from here to there. We do those on Wednesday on the credit cards.
Okay.
okay, I'm sorry. I'm invading another space then.
I'm sorry. Did I answer your question? I forgot who answered that. Who asked that question?
Ryan, that we lost him, Ryan. I don't know.
Yeah.
We lost him. No, Ryan's good. Anna,
Oh, no, that was me that asked
Ryan.
the qualifications of a
Anon.
HELOC.
Yeah, HELOCs are credit based. And typically you want to have 25% or more equity in your home to value.
Okay.
Mean that it increased 20 to 25%. That be
What's that?
that you can pull out 20 to 25% of equity from the
No,
property?
you're not going to be able to put. Let's say your house is worth 400,000 and you owe 300, so you have $100,000 in equity. You're not going to be able to pull all $100,000 out of the HELOC.
Okay.
Yeah, usually it's 80% loan to value, no, Mike? Like
Yeah.
up to 80% loan
Up
to
to
value.
80%. Yeah.
Your purchase and your HELOC can go only up to 80%.
Yeah, it's
in single
typically
family.
around 65, 70% banks are comfortable with, but you will find them that will go up to 75 to 80. And usually if it's a relationship that with a bank that you already have, you're have a better chance of getting the higher rate.
Okay.
Primary homes. Very good, very good. So the conclusion, guys. Tamar, what we do? Do you go for the interest only, or do you go for the amortized DSCR? What will
Depends.
you do? It depends. That's a real estate answer. That's not. That's the real estate answer.
No, yeah, what I understood is interest with the idea that you have control. Like you have to know what your plans are, right? In terms of so you can make those payments after that. So basically interest, but you still have to be very disciplined of how you're going to make those payments.
But just when we look I look Anna, and I know your credit score is going to be 780. I mean, you are disciplined already. I mean, if you are an investor, you have discipline already. I mean, discipline only means don't throw away money. So we are disciplined already.
No,
Yeah.
actually, I had to. I had some unusual spends. I was taking care of my mom for 3 years, so I had to do a lot on credit. So I'm trying to rebuild that.
And that's the DSCR is a perfect product for an investor like you, where you had some situations out of your control for a couple of years, your credit got hurt, but if you find the right property that cash flows, your credit doesn't matter.
Right.
You know, I mean, your interest may be a little bit higher because credit has some consideration, but it's on a scale of percentage wise, it's like 10% of what we look at when it comes to funding a DSCR loan.
Yeah, it's the property and the income. The property and the income. That's why we love DSCR loans.
Did
Javier,
you say that? I was just going to say, is interest only a better interest rate than doing interest with principal?
No, it's a higher interest rate.
No, Michael, don't answer that. We make people think here. You are the bank. Interest only
Right.
is a lower payment. The
Right,
other
so
one
yeah.
has a higher payment. What do you want, bank? Do you want people to be interest only, or do you want people to be on principal and interest interest?
No, I want
Yeah, of
principal
course.
and
So
as a banker.
the interest only is higher interest.
Got you. Okay.
But don't get so hung up on the interest rate. If you find a home that cash flows and has a good DSCR number, let's say, right now interest rates are coming down, but don't let that stop you from making a good deal. Because you can always refinance outside of that prepayment penalty era. If it's 3 years, if you want to do 3 years, then you can wait till then. But I would say don't let interest rates stop you from finding the right investment and not pulling the trigger because of it.
Gotcha.
That's a good advice, but I would say before that, do the numbers. Let's do the numbers, then we can take some, how to call it, control risk? No.
Calculated risk.
Calculated risk. That's the correct answer. Javier, do the closing. You're a closer.
All right, we do the closing, people. Wake up. The closing tonight, it was great. Really, thank you, MJ. We recover 3 minutes of the late start. I know, guys, that if you want to bring Michael again, Michael will be more than happy to do another. We got so many other things to talk about, loans and stuff. And you can go more personal on your things with MJ on the side, that's for sure. And again, when we do the deal review, we all the time talk about these things. So hopefully now, today, you can make hit home some of the things that we do when we go through the simple Excel spreadsheet that we are trying to figure out if a deal is good or not. But that's what we're trying to do here. So bring some other people, spread the word. We will continue doing these things every Thursday. And if you learn something, just, bring more people to your wheelhouse, and we can do credit cards or simple money, and
Absolutely. I'm actually
keep
working on
growing. So that's what I would say.
I'm currently working on an ebook right now for formulas for investors, that they can use these formulas for the NOI, the DSCR, cap rate, and find all these numbers themselves just using a piece of paper and a pen. And I'm working on that right now, so maybe I can bring that next time so all you guys can have that information, and you can do the numbers yourself without having to use a calculator or having to call this person, call that person. And then you can come to someone like me and say, I have all these numbers already done, ready to go. And it, more information is more power. So that's something I'd like to bring to you guys, maybe next time I'm on with you.
Very good, very good. Okay, guys, thank you very much for coming. See you next Tuesday, next Monday. Mastermind we'll see on Monday. The rest we'll see on Tuesday. Not this Tuesday, but we'll come in. Okay, thank you, guys.
Yes, thank you all. Thank you, MJ.
No problem. Have a good night.
Thank you, guys. Thanks a lot. Have a great evening.